We typically have these Q&As usually every month. I took some time off over the holidays and apparently was slow to restart them this year, but the next Q&A will be in April. So we will keep having these. Sometimes I do a specific topic if we're seeing a certain trend going on, but for now I wanted to leave it pretty generic. So my name is Ivory. So I own Insight Strategies Credit Repair. We focus obviously on credit repair, but we have a very heavy focus on credit education as well, both to consumers and then also to loan officers, business bankers, really anybody that's approving a consumer for any sort of lending product. I've worked all over the place when it comes to the default side of the financial services industry, on the regulatory compliance side as well, dealing directly with the CFPB, all of the laws and regulations that are used in credit reporting. And then I do have a background as well in financial planning. Okay, no video, not seeing video. Is everyone else seeing video? Anyone else having trouble seeing video?
No, I have video and audio.
Okay. Okay. I think Todd, you might need to exit and come back in, and then it might fix itself. So sorry about that. Okay, I'll go ahead.
Or
and
maybe like I forget to lift up the camera on my computer desktop. I have a desktop and sometimes I forget to slide it up.
Flip it open.
But yeah, flip it open. You're right. Right. That might be it too. I do that quite a bit. So
I'm not sure. Hopefully, Todd, you'll be able to get in here. Okay, so why are we here talking about credit? Well, it is the number one reason for denials along with debt to income ratio. Credit and debt to income ratio tend to go hand in hand. Typically, if somebody has higher debt to income ratio, they typically have some adverse impact to their credit, whether it just has to do with high utilization on credit cards or actually having negative accounts. Because it is one of the top denial reasons, I do want to make sure, of course, as loan officers, you have access to good information so you can do something about it, so you can approve more loans. And in today's lending environment, with rates being higher, home prices still being high, it's really squeezing out a lot of potential borrowers. So any control we have is just very important. So, all right. A couple things that I like to get into before going into the actual Q&A topics, in case this is new to anybody, there are multiple different versions of the FICO credit score. That's really important to know because your borrowers are coming to you typically thinking that they know their credit score, or they're pulling it up somewhere like Credit Karma, Credit Sesame. They are seeing it on their Chase Bank app or their credit card company website. And they're typically not seeing the score used in mortgage lending, which is called FICO Classic. So what you'll see here on the screen is FICO Classic is right here, version 2, 5, and 4. The algorithm itself is the same across the board between Experian, Equifax, and TransUnion, even though that number is different. The classic score is the first standard iteration of credit scoring, and they used to let the bureaus call them whatever number they wanted. So most people just refer to it as FICO Classic or the mortgage FICO score. But when you are pulling a credit report, if you go to the very end of the credit report, you'll see it'll say Experian, FICO 2, 5, etc. So that is the score used. So for any consumer that's coming to you, if they have access to, let's say, like the Experian or My FICO or My Score IQ, My Score IQ and My FICO do give them this credit score. So those clients will know their credit score. Experian has a paid option, which will give them their mortgage FICO score. But most of the time, they're going to be seeing something like the FICO 8, or they're going to be seeing a Vantage credit score, which is unreliable at best. When we work with clients, we give them access to all of these scores so they know where they're at depending on what they're trying to do. But most of our clients here focus on mortgage FICO. Does anybody have any questions about FICO versions? I'm not going to really go too deep into it today.
Does one score higher? Do the FICO Classic scores typically come in lower than the others?
Most, if there's credit damage, most of the time they come in lower. Not all of the time, but most of the time they'll come in lower. If there's not credit damage, it's kind of all over the place. But oftentimes if there's credit damage, this score does tend to be a bit lower than some of the other versions of FICO. Now, things like the auto lending FICO and credit card decisioning FICO are more specifically geared towards the history of credit cards or the history of installment loans, specifically the auto loans. So those scores are more narrow in focus and are going to be vastly different than the base FICO score, like the base FICO 8 or base FICO 9. I do have 9 on here, 9 and 10. So these are going to be completely different than like any base FICO score. So hopefully that answers your question. Any other questions on FICO versions at all? Okay, let's go on. So regardless of the version of the FICO score, every credit score algorithm, whether it's 4, 5, 6, etc., is made up of these components. Biggest impact being payment history, second biggest impact being utilization, third being the length of credit history. New credit really is comprised of, did they open new accounts, and then inquiries. And then lastly, the credit mix or the types of credit being used. So that's the blend between having revolving accounts and having installment accounts. So do you have credit card history? Do you also have history on loans? Where we have control in the credit repair space is pretty much all of these factors, with the exception of length of credit. A lot more limited control there, right? You can't just create longevity out of thin air other than using something like an authorized user account. So when it comes to your simulator, oftentimes the simulator is more heavily focused on the utilization, this 30% factor. And then the dispute process for credit repair is obviously focused on the payment history or removing negative history, and then influencing on the positive side by adding good information to the report too. So the way this information is interpreted is what creates the differences in all of these versions of FICO scoring. Some versions of FICO time weight information. So the older the late payment, the less impactful to the score. Some don't, for example. So I wasn't planning on getting too far into this. Some of the questions that were submitted will touch on these topics, of course. But did anyone have any general questions about the factors that create a FICO score? Okay, silence means no. All right, let's move on. So I've broken each of the questions that were submitted into sections. So the first section we're going to talk about is questions on collections. So how do old collections affect the credit score? So for the version of FICO you're using, the mortgage FICO, or that FICO Classic, it has a large impact on the credit score. It doesn't really matter if that collection's 5 years old or if it happened, let's say within the last few months. A collection is considered a severe delinquency, so you're going to see a large impact to the credit score. Now, there is some nuance to this. If this is an individual who has a lot of collections and then they get one brand new collection, they might only see their score drop an additional 10 or 15 points, right? So if they're already in the 500s, let's say they're at 558, maybe they drop down to 540. For somebody who is in the higher credit score range, I'll give you an example. We had a client, she was 800, 798, and another really high score, 780, 790-ish range. She got one collection, it dropped her down to the 680s. And that's because her history is overwhelmingly positive. So the algorithm looks at this new collection being added as a significant risk because it deviates from her behavior so much. So that being said, if you have a client who was in the amazing credit score range and is now negatively impacted by a new collection, that can be the type of individual where you may want to look at credit repair or have that client call that collection company and offer a pay for delete, a payment in exchange for them deleting the account. account must be deleted for you to see a positive impact to the credit score. If a borrower, just to answer the question in the chat, if a borrower has an old collection and they pay it off, and that collection company does not agree to delete the account from the credit report, the impact to the credit report, to the credit score itself, really is null. There isn't an impact. Where people often get confused about this is the Vantage credit score algorithm. So if they're using Credit Karma, it encourages them to pay the collection, and it improves the Vantage score. It does not improve the FICO score. Only the deletion of the account improves the FICO score. So that's a pretty important differentiating factor. Another important factor, actually, it's one of the questions, so I will wait till I get to that question. If I can. Okay, so medical collections. This is exactly where I was going to segue. So medical collections, there's a new law passed July 2022. If a medical collection is paid, it will be deleted from the credit report. So if you have a client who has just a bunch of tiny little, $30, $60 copays showing up on their credit report, just have them pay it. They don't need credit repair if that's the only thing impacting their credit score. Have them pay it. It'll update within about 30 days to 45 days. You may be able to do a rapid rescore if that collection company is willing to send a letter that says they agreed to remove it from the report. But yeah, pay it, score will jump right up. So that's the other new thing coming up later with medical collections. It was supposed to happen this first quarter, and now they're telling us second quarter, who knows? When there is a medical collection that's less than $500, eventually they are no longer going to report to the bureaus. We have no guidance onto the exact date that that's going to happen, but there is a lot of misconception on the consumer side, thinking that they're no longer reporting anymore. So you may see some surprised borrowers when you pull their credit and you see that there are still medical collections reporting that are under 500 that are unpaid specifically. So eventually unpaid under 500 won't report. I'll let you know when that happens. So
Ivory, how many months was that for the 500?
how many
score?
what?
How many? I thought you said after so many months.
Oh, no. So they're supposed to, it's going to be an automatic, like every credit report's going to be updated once the law goes through. We just don't know when they're actually going to do it. So they've announced that they are doing it. CFPB has said, yes, this is coming out. It was supposed to come out by January of this year. Didn't happen. Now they're saying sometime second quarter. I'm guessing they're just going to keep pushing it back until all of a sudden it happens. That's kind of what happened in July. They were like, oh, well, maybe it'll happen early this year. And then they announced 30 days before they released it. So I think it'll be short notice. The nice thing is when they do make changes like this, it's instant, like everything's pulled off. The bureaus pull everything off the credit report that day. So it's a quick, it's not like, oh, in 60 days, you'll see them all removed. So, so if they have a $600 medical collection showing, could it be beneficial to their credit score to pay it? Yes, it would be beneficial to their credit score to pay it, because once it's paid, it will be removed. Now, I still caution people, I see so many billing errors with medical collections. So I always caution people to make sure, if they're not going to do credit repair because they have a whole bunch of other issues that need to be worked on, to make sure they are finding out if that bill is valid. We see errors where the customer is billed first and then they bill insurance later, and they forget to pull the collection back from the collection company. So that's an issue, because if they don't owe it, it'll just be deleted without them having to pay it. So don't trust collection companies. That's like rule number one. Always do your due diligence and make sure that that consumer is going to them and asking for some sort of documentation, intake forms. If they improperly did not bill insurance, they only have 2 years. So if it's past that 2-year mark, they just got to pay it. It was their responsibility to make sure insurance got billed within a 2-year time frame. So, new activity on the account, does that cause an additional drop in score? So I'm assuming new activity on the collection. So let's say we have somebody, if I'm understanding the question right, let's say we have somebody, it's not a medical collection in this example. Let's say they pay that collection and now the balance is updated to 0. Does that adversely impact the credit score? It does not. A lot of times we'll see something else has caused the score to go down, and people will incorrectly attribute it to a different action they've taken, like paying off the collection. It doesn't reset any clocks. That's a big myth that you'll see all over the internet, because a collection can only appear on the credit report for 7 years from the original delinquency, not from when that collection company bought the debt. So people will think it resets that 7-year timer. Absolutely does not. There is something that's called re-aging. It's an illegal practice that a lot of collection companies use to keep a debt on the credit report longer than they should. Consumers are actually entitled to monetary compensation if they want to hire an attorney, if they do identify re-aging happening. It's not a ton of money, but I mean, it can add up if there's a lot of accounts. So, yeah. Let's see, I'm reading a question, so bear with me. Oregon Department of Revenue as a debt collector. Okay, government debt collectors, you're kind of SOL, to be quite frank. Any government debt collection, you got to get an attorney. Don't waste your time with a credit repair company. I know I have a credit repair company, but we are too limited in scope. It's not worth the consumer's money to hire anyone in credit repair. They should only hire an attorney if they are disputing any debt with any sort of a government entity collecting on it, whether that's parking tickets. It doesn't matter what it is, anything government related. We're not going to get off the report. Just a fact. So either pay it or get an attorney is the reality. So, okay. How do you dispute collections? So bear with me on this and please tell me if something doesn't make sense. I'm going to try to be short and sweet, but I'm a rambler, so I apologize ahead of time. So with collection accounts, with this question that was submitted, I'm guessing the goal is to find out what's possible to get removed. So collections have the highest success rate for removals for any sort of derogatory information on a credit report. It's because they have a lot of regulations that collection company, and then of course that the credit bureaus have to abide by. So you can think of it as like 2 different bubbles of rules. We've got the credit bureaus have a set of rules, the collection company has a set of rules they have to abide by, and then we've got the overarching rules that are over both of them. So whenever you go through a dispute process with a collection account, there's a simultaneous process with the collection company and the bureaus because you're disputing different regulatory issues. With collection agencies, number one way to get something removed is through a validation process. So this is simply just a request for documentation. Do they have proof they owe that consumer owes the debt? It doesn't matter if the consumer knows they owe the debt, right? Because at the end of the day, it's based on when they purchase the debt, did they get that documentation with that purchase of debt? And they're buying pools of debt. Most of the time that answer is no. That doesn't mean they can't go back to that original creditor and get it, right? So you submit a request for validation, they're simply going to go back to that original creditor and request the documentation. If that's been purged at this point, or that original creditor is like, it's on you to figure it out, we don't care about this debt anymore because we already sold it to you, then they now can respond one of 2 ways. Number 1, silence. Number 2, they reply back with, we're going to remove it from the credit report, or it just all of a sudden appears deleted because they don't want to admit liability. So if they reply with silence, that's usually them assuming the consumer doesn't know what to do when there's silence. The consumer, so the reason they'll reply with silence is because if they don't have proof of the debt, they are hoping that that consumer is going to call them and pay on it. Because once they don't reply on validation, they can no longer try to call and collect. So they can't reach out to that consumer now without providing the proof. But by leaving it on the credit report, it can still entice that consumer to call in and pay the debt because that consumer wants it off their report. So after silence, usually we send what's called an estoppel by silence, which basically is just saying your silence is telling me you don't have any proof that I owe the debt. And then after that, you can go to the credit bureaus and you can say, credit bureaus, how can you be reporting something that hasn't been proven? If the consumer can't get access to documentation on this debt, how in the world were you able to verify that it's something valid? So there's some different tactics there, but that's the main way of disputing a collection. If they have proper validation, that's when you go the pay for delete route, right? It's valid, consumer owes the debt. You offer a payment in exchange for that collection company agreeing to delete that account from the credit report. Ultimate goal is always delete from the credit report. And, you know, sometimes things do have to be paid, unfortunately. So.
Hey, Ivory,
Mhm.
I think you already mentioned this, but how long does it take for it to be removed from the credit report once a consumer's paid that debt?
Hold on one second. Once the consumer, hold on, Zoom's giving me an error message on my end. Once the consumer pays the debt, it's usually about 30 to 45 days before you'll see it updated. So a lot of collection companies will report to the credit bureaus every month, or excuse me, every week. But the credit bureaus themselves often take a little bit of a lag time to update it. So usually I'd say 30 to 45 days. Any letters they send will say 60 days, up to 60 days. So just a heads up there. It's usually fairly quick though. And then what else was I going to say? As far as like, there's a separate dispute process for dealing directly with the credit bureaus themselves, but I won't necessarily get into that. Now, an important thing is if you do have a borrower who wants to do the credit repair process themselves, make sure that they are requesting validation in writing. It does need to be in writing. They're not protected in the same way if it's just requested over the phone. So, okay, let's see. Sorry, it's like giving me a Zoom error message, so forgive me while I'm multitasking here. All right. Any other questions about collection accounts? Because we're going to move on from collection. So if there's another question, let me know, and then I will make sure.
Actually, I do have a quick question.
Yeah.
Is it faster or better to have collections paid off through escrow at time of closing or not?
It's not going to help the score. So I would do it before, because you definitely want this score to be, you know, that's usually the point. If it doesn't matter for score, then yeah, you could do it that way. So I am trying to figure out why this is giving me whatever. I'm just going to do this. Sorry, it's telling me it's going to kick everyone out. So I'm trying to do damage control before everyone gets kicked out of the meeting. Okay. Sure. Okay. Next. So the next thing that we are going to look at are our miscellaneous questions section, as I called it. So number one, when do you go after accounts with delinquent payments? So this was an interesting question. My assumption, this can go down so many paths. So if this was your question, definitely let me know if you had a specific path you wanted to go down. And then actually, before I jump into this, I did get a question from someone on a collection, it looks like. How do you get a delete letter and not get scammed for a payment? So when clients work with us, we tend to send it in writing, the pay for delete in writing, and we make them sign a document and send it back saying they're going to delete it. You can also have the collection company email that client if they pay over the phone, confirming they'll get it deleted from the credit report. But I mean, there are collection companies we know we can trust. So like LVNV, Portfolio Recovery, those are really big companies that tend to collect for most credit card debts. You can trust them. They always will send something in the mail, but unfortunately, there's no surefire way unless you're getting an email right there. Okay. Okay. And then, okay, let me make sure I got this fixed. I think I did. Hopefully we're okay. And then I'm gonna get back into the meeting. Okay. So when do you go after accounts with delinquent payments? So again, getting back into this, there's a couple of ways we know we can get delinquent payments deleted. One of the difficult things you have on the loan officer side is you have a tri-merged credit report, so you can't see the differences between all three credit bureaus. So on the credit restoration side, we're looking at inconsistencies between Equifax, TransUnion, and Experian. So with Equifax, TransUnion, and Experian, because they're siloed, they're their own private companies, they're not necessarily sharing information with one another unless it's related to like fraud, like a credit freeze, for example. We'll often see things like late payment showing for August 2020 on one bureau and September 2020 on another, or on the other two bureaus. Okay. And then with another example is we may see on a customer statement that it shows that they were delinquent in August, but maybe all three bureaus show the delinquency in September. That's pretty common. Those instances are going to be instances where we know, okay, we can go after delinquent payments to get those removed from the credit report, because Fair Credit Reporting Act says everything has to be accurate. Any inconsistencies in that reporting behavior for late payments can be disputed to get it removed. So late payments, you know, if they are valid, if the documentation supports it, there's not really too much you can do otherwise. Now, because of the CARES Act, anything after January, I think it's 10th, 2020, if there is a late payment that has occurred there and the creditor has provided an accommodation can be described as a deferment, forbearance, modification, the waiver of a late payment, for example. If any of that has occurred to allow the consumer to become current, then the derogatory mark associated with that accommodation can be removed from the credit report. It's very plain. You just give the CARES Act to the creditor. They're required to remove the late payment. Most people don't realize that. So that's going to end at some point, right? It's still valid right now for even late payments going on right now. So if I have a client who's working with me and something happens, they have a late payment, I call them right away and call them, ask for the late fee to be waived, and then we'll circle back and get that late mark removed. So common instance, we see this, deferments or forbearances during with mortgages. That's one of the bigger ones you see quite a bit. And then auto loans. We see it a lot with those as well. Now, the key is it must bring them current. So if it did not bring them current, that doesn't work. And then the obvious things are errors, right? We'll see errors, like blatant errors, where let's say they paid off an account completely and they got marked past due the following month when the account was already closed, right? There's going to be any sort of nuance. I'm reading a question here. Isn't it true credit repair companies often have relationships with particular collectors and can often have an easier time negotiating payoff and or deletion letter? I think some of the larger companies do have relationships. We do not have any sort of relationship like that. So I can't speak too much on that. I get leery of anyone that I get leery of any credit repair company that has a relationship with a collection company, because it tends to make me think that they are telling the collector, we're going to guarantee you get paid for everybody we work with. And I don't necessarily like the sound of that. So I don't know. That's me. If an account has late history, but the account is closed, how can they get that removed, or when does it fall off? When does it fall off? So if anything derogatory on the credit report automatically falls off after 7 years. So that late mark would fall off after 7 years. Now, if it's a closed account, burden of proof is always on the creditor. So you can make it this simple. A consumer can write a letter to the creditor and say, I don't remember being late. Can you give me proof that I was late? Like, if they want to really oversimplify it. If that creditor cannot supply the proof, they're required to update that payment history to current. So like if we have clients that have, payments that are 6 years old and they do not know, we just ask for statements. If they don't have statements, it has to be updated to current. So everything is pretty much about proof, if you want to boil it down to simplicity, for the most part. And this is why credit repair is not an overnight process. It's literally looking for all of the holes, everything that's missing, all of the gaps.
Can I add
mhm.
something?
Go
Can
for
I
it.
ask that goes on that? So, say we have a client who like did the delete letters and stuff,
Yeah.
and the only thing that came back was that the creditors are like, no, we've confirmed that this is you, but has not provided any sort of proof. Then what would a consumer do?
So let me ask a clarifying question. Are you saying they requested like validation for the collection and all they got back was a letter saying, yes, this is your debt?
Yeah, they just
Mhm.
updated the dispute
Mhm.
status to saying that what was it that they confirmed that it actually was
Verified.
right, but that
Yeah.
did not supply to the consumer any sort of proof that it actually was theirs.
It's pretty common for that to happen. They're hoping that the consumer doesn't know they can continue to press on that. We would rebut that, essentially saying this is not validation. So you basically have to rebut it and go back. If you really continue to have issues, you can go to the credit bureau route, say, hey, we never got any proof of this. Or you can just file a regulatory complaint with the not regulatory, you can file a complaint with the CFPB directly on that collection company and say they failed to provide validation upon request. Now, the best way for any consumer to handle a collection is when they get the collection, they get a letter notifying them of the collection. They don't always, but they're supposed to get a letter notifying them of the collection. And they should immediately request validation at that point, because it will be suppressed from reporting until verified in those instances. They have way more protection when the collection is brand new than after it's been on the report for a while. Sometimes what a consumer will see in these types of situations is that, let's say they do go back and rebut and say, hey, this isn't proof. The collection company will sell the debt to a different agency, and then you'll see it removed and then pop up on the credit report again with a new agency. You follow the cycle of validation until they give up is really what ends up happening there. The furthest I've seen it go is three company changes before it fell off, but they want their piece of the pie for what they bought. So I don't know if that answered as much as you may have been looking for.
No,
But-
that was great. Thank you.
Okay. I think that was it for collections. Okay. What is the best way to handle, I don't know if I went ahead 2 or 1. Okay, I did. What is the best way to handle an auto repossession on a credit report? The actual best way is credit repair, but not the only way. So if credit repair is not an option for the borrower, the best way to see an improvement to their credit score is to get that balance updated to 0. So settle on the amount. Now, it's really important to know that I often see errors with the balance showing, meaning after the vehicle has been repossessed, if they sold that vehicle, there's going to be the sale price minus what they owed, the deficit balance. Sometimes the credit report doesn't get updated with the deficit balance. So that it might show that full balance, that full loan amount still. So the consumer can call that creditor and find out what the true balance owed is, because it very well may be less than what's showing on the credit report, and see if they can settle. Always offer 30% as a starting point for settling on the account. Full payoff for settlement really doesn't matter once it's this derogatory. You just really need it to be updated to 0, and you'll see some positive impact to the credit score. It's not always going to be the most amazing score jump, but it is going to be helpful, especially if you have to have that paid off because of the total dollar amount showing on the credit report. So there's a lot of issues with repossessions, often with documentation supplied to the consumer during the repossession process, but it can get fairly complex there. So, you know, the easy route is pay it, and it will help a bit if they're not going to do credit repair. So hopefully, if that was your question, that answered your question sufficiently. Okay. Once all debt is paid off, how long does it take for the credit score to be a better score after the debt's paid? So, if we're talking on time, not on time, if we're talking an open and active account, a couple days before the statement cut date is going to be when the creditor is reporting information to the bureau. So as long as the accounts are paid before that point, you're going to see it reflected on the next time the creditor sends the information. Usually about 30 days at the longest is what it's going to take for you to see the change to the score. Some creditors are better at reporting every month than others. So the worst I've seen is 90 days for a creditor, but most of the time it's 30 days. Keep in mind, when we're talking about paying debt off to help see a score improvement, that is going to be specific to utilization ratio. Okay. So if you're trying to pay debt off for a score improvement, that's not usually going to be tied to any sort of a loan. It's going to be tied to credit cards. Optimal utilization is 1 to 9%. Usually if you're running the simulator, that's what they're going to be recommending, is getting the balance between 1 and 9%. If you actually calculate it, that's what you'll tend to see. But that's considered optimal. Other than that, anything that is charged off, repossessions, as we mentioned, any sort of derogatory debt with an original creditor, if updated to 0, will help the score. It's just collections you're not going to see a benefit to. It is beneficial to pay off a charge off or settle on a charge off, what have you, because you don't want it sold to a third-party collection agency either. That's the other reason, because if it's sold to that third-party collection agency, all of a sudden you got double jeopardy. You're hit once for the original creditor and then once for the collection company, and now you got to deal with the collections. So, all right, we'll move on to the next question. Borrower has a dispute on a charge off that's about 2 years old. What impact can be anticipated once they remove the in dispute status? It's impossible to say without looking at the credit report, to be quite frank. If the in dispute is suppressing the impact of the charge off, then it can be pretty sizable. The trouble is the in dispute status isn't always suppressing the impact. And we don't know. There's no way for me or you to know, because that's all in the bureau and whether they did things properly on their end. 70% of the time they have errors. So it's often they don't actually suppress the information. You definitely do see it from time to time, but hopefully this would be a scenario where it's not suppressed. So yeah. Any new strategies on the credit repair process? There's always evolution. It's all based on law. So as laws change or are modified or regulations are modified, then there's changes in the process. CARES Act is probably the biggest one as far as a recent change. You can use FEMA as well. So if someone is within, I have to look, but I think it's like 300 miles of a disaster and they're considered to be in a FEMA impact zone, you can use that to get rid of late payments. So simply asking the creditor, were they in a FEMA zone? And you have to leave it on to the creditor to determine that. But There's always new strategies. So every April, I attend a conference with all the credit repair companies across the country, and we basically trade resources and information so we can be better. We meet with FICO, so anytime, and we meet with some of the big guys in the government. So as there are changes, we update the process, but main strategies are going to be around using factual disputing and using the actual laws and regulations. Not every credit repair company does that. A lot of the strategies we use are also around the rebuilding side or the restructuring side, and just looking at optimizing what works well and filling in the gaps. So I think most of the new strategies for a lot of companies are around that, because there didn't used to be so many credit building resources even in the last 5 years. So kind of a general answer, but hopefully that helps. Oh, I liked this one. Will it hurt scores to do an auto refinance? I kind of just copy and pasted, so apologize for the grammar. So refinancing auto payments to reduce monthly payment to qualify for debt to income. So a lot of times where we see issues with closing accounts is related to the average age of accounts on the credit report. So if that auto loan had been open for a really long time and then it's closed and you open a new loan, the open accounts factor a lot more heavily as far as the average age of accounts. So that closure can have a negative impact, and then the opening of the new account will also obviously adjust the average age of account. So it can impact the score, but sometimes you got to take a little hit because you got to qualify for debt to income. So you might create some cushion through other means, and I'll show you what that looks like here later. And actually, now I'm going to show you what that looks like now. So reason codes, we're going to get into reason codes, and this will make sense in a moment when I explain what a reason code is. So these two questions and that last question are really going to pertain to why I'm going to be bringing up reason codes. So if someone is borderline eligible with a score below 620, what are ways to boost their score? How do we determine what clients need to keep on their credit and what they need to resolve? So reason codes, your secret to everything. Every credit report you pull has this section. It'll look a little bit different depending on who your provider is that you get your reports from. This tells you what needs to happen. So for every question that was about how do I get boosts in the credit score, what can I do to quickly cause increases, etc., this is what you can do. So I'm going to show you a couple of examples. So reason codes are these actual numbered codes, but the important part is not the number, it's what they say. So there is a section for each, oh, you can see my mouse. There's a section for each bureau, right? So these are ranked in order of what's the most impactful to pull the score down. So the top 4 to 5 things bringing the score down. So what you want to do is you want to influence, obviously, the top few factors. So length of time accounts have been established. This tells me, obviously, that the average age of accounts is too short. Solution. Do they have a family member that has a credit card that's been opened a long time? Authorized user, right? Obviously good standing, obviously low utilization. Okay, so if that's added to their report, that's no longer the most impactful aspect bringing their score down. You'll see a good increase in score. So then we move on to the next one, level of delinquency. Well, not much you can do there other than the credit repair side. Too many accounts with balances. Well, great, pay down the credit cards. Another huge impact. Okay, consumer, let's say, doesn't have the ability to pay down credit cards. If their score is decent enough, they can do a consolidation loan, shift it to an installment loan, right? We do that for clients that have really high credit card debt. Because one, they're actually going to pay it down faster. Interest rates are going to be lower than credit cards, 23 to 28% right now. But it also impacts their utilization ratio more positively. Too many inquiries, again, and accounts with delinquency, not much you can do there unless it's the credit repair side of things. But if this person needed to get to 680 on, let's say, Experian, they'd be able to get there by those two simple factors that they could influence. So reason codes are your friend. And they will be different from bureau to bureau just based on what's reporting on each bureau. Not all creditors, not all collection companies, for example, report to all 3 bureaus. or maybe there's inconsistent information across the three. We'll look at another one. So this is meant to show you that even great credit scores have reason codes. So unless you're a perfect FICO, absolutely perfect score, there's going to be reason codes. There's still going to be something that pulls the score down. Now, you may only have 1 or 2 reason codes, but there's still going to be something that pulls the score down. So time since most recent account open too short, too many inquiries last few months. So these things aren't going to be a massive factor. Remember, inquiries is only 10% of the score. And then the rest is all just time related. So this is really just meant to show you that a good credit score can still have reason codes. Okay. Lack of recent activity, no scores. So this is really just showing you why this reason code is really just telling you there's just not enough information on the credit report to generate a score. If they have, they may even have a couple accounts on their credit report, but if their accounts have not had any activity within the last 6 months, then a score may not be generated because you do have to have activity within 6 months. So if they closed the account 7 months ago, and that was their only active account, if they have a credit card even that's open and active, but they haven't used it in 6 months, that can be a problem. They use their card once, all of a sudden the scores populate, they're good to go. So for anyone in this type of situation who doesn't know what to do, our website does have a credit establishment or reestablishment plan for $25. So if they're not sure what to do themselves, you can direct them there. It's a quick plan they follow in 1 to 3 months. They're good to go. Okay. Having no credit cards is a massive factor in credit scores. I wanted to bring this one up because for this client, their score jumped to the mid 600s just from opening a credit card, even with the delinquencies that had occurred. Okay. This is really important because again, credit cards or that utilization ratio impacts 30% of the credit score. So there's no open credit card. You're completely just missing out on that factor. So just in this case, lack of recent revolving account information, lack of recent bank revolving information, it's 2 of the factors bringing their score down. All that person has to do is open a credit card. Did they still do credit repair to work on the delinquencies? Yes, but they were able to qualify without having to do credit repair. So there's a lot you have control over if you just read these reason codes. And again, they're on every report. And if you're not sure what to do, just talk to me because I can read the report and tell you. Okay, so for anyone who doesn't work with us, if you have those situations where the clients do need help on the credit repair, actually, before I get into that, I'll answer this question. Does secured versus unsecured credit card have more impact? No. The credit score algorithm doesn't care if it's secured or unsecured. It's a credit card to the algorithm. So for anybody that wants to work with us, we have a partnership portal. So any client that's referred, that's sent through that portal is automatically attached to you as the loan officer or real estate agent. And as a loan officer, you're able to track their progress in the portal. You can see how their scores are changing. We include you on the updates when there are big score jumps as well. But once you submit them in the portal, they're immediately contacted with an email that says you referred them our way. It gives them a link for our calendar, for my calendar, to book time, or I call them within 24 hours, business hours, not on the weekend. And then after that, we let you know how that communication went, whether they need credit repair or not. Sometimes we can give them enough to do without us, especially if they don't have the funds to do credit repair. And that's pretty much it. Timeline wise, for somebody in the 400 to 500s, they're usually with us 6 months to 8 months to get to the mid 7s on average. Sometimes it's faster, sometimes it's slower. It depends on how much we're working on. And I'll give you an example of what we've been able to do this year so far. So this is just January and February's numbers. 123 collections removed, just under $70,000 without our clients having to pay. Charge-offs so far at $90,000 with no payment required for our clients. And that's 34 charge-offs. Late marks, again, the hardest thing, only 15 accounts where they were all removed, every late mark. And then derogatory student loans, 48 removed and 106 inquiries deleted. We like to keep track of our biggest score jumps in 30 days. So some nice jumps we had over 30-day timeframes, but this is the rarity, not the norm. It's just sometimes fun to see if we can outdo ourselves. So I don't know. The biggest one we've ever had is 198 points, and I don't know if we'll ever outdo that, but who knows? And then I just wanted to show you some results that are possible. So clients start coming from the 500s to, you know, like I said, 700s. And we had this client here, the third one down, one collection dropped her to the 630, 640 on the 2 bureaus it reported. And then when we were done with the process with her, put her right back up 799, 793, 781. So it's not necessarily always the client that's in the 400 to 500s we get, especially now as we're seeing higher credit score requirements or higher scores needed. We're getting a lot of clients in the low 7s or high 6s that are working with us to get, you know, to this nice range. So if there's any damage, we can typically help. And we'll let the client know if we don't think there's a good chance, and then it's kind of up to them. Do you want to risk it? We're very transparent. I want people to be happy with what we do. So we don't want to blow smoke. Okay, let's see. I think that's it. This is my contact information. We have a credit education course for both consumers and professionals. It's the ins and outs of absolutely everything that is credit related. And then there's a lot of content on YouTube too. So every webinar that I do, as long as I remember to record it, is posted. And then if you want to partner, you can fill out a partnership form on our website, or you can just email me. I'll be emailing a copy of this webinar out, so you can always just reply back to that. And if you have any specific scenarios or credit reports you want reviewed, always happy to review a report for you too. And then just let me know if you have any particular scenarios. But with that, I'll leave it open. Is there anything we have not covered that you have questions on? Okay, it sounds like I was that amazing at going through all the
Yeah,
content.
hold on, Ivory. I have one
Okay,
question.
go for it.
This is just a little bit off track here, but
Yeah, that's fine.
I'm just kind of wondering, I've heard something through the grapevine. This has been, what, a year now, about social credit.
Oh,
And it's supposed to take over like this credit, like credit card credit scores and stuff like that. Do you have any insight or knowledge about that? What's with that?
yeah. So I haven't heard of that being initiated here in the US. It does exist in other countries. We actually have the least discriminatory, excuse me, credit system in the world. So we're the only country that cannot discriminate based on who you are, I guess is the easiest way to put it.
Right. Okay.
So I have not heard of any changes in that at this point.
Okay.
I will be in, if I hear anything, I'll know in April when we attend. I'm attending a conference with all the big guys that make our system. So I'll let you know if there's anything on the horizon. But I am anticipating a change in models or an additional models being used in the mortgage industry. So I would anticipate some communication coming from me about that end of April, early May. So.
Okay. Do you think it's going to be better or worse or indifferent or just something totally?
I think it's going to be better for people who don't have scores. And that's probably what it's going to be geared towards based on what we've been told so far. So,
okay. All right.
We won't
Thank
know
you.
until the actual legislation is done, which isn't supposed to. We just don't have it. It's not done yet.
Right.
So.
Okay. All right. Thank you.
Yeah. And then Kelly, I think you had something.
Yeah.
Oh.
I would just put it in the chat. Does an installment loan have more impact than a credit card when building credit? Because people come, how do I get started? How do I goose it from the beginning? Yeah. I'm like, diversification is good.
Yes. And you're right. Diversification is good. So you really want both. So we typically use a credit builder account that has a secured credit card attached to the balance of the credit builder account, because you want credit mix to hit the installment and then the revolving side through the credit card. So usually you do want both, but if they're, let's say they're like not comfortable, if you have to pick one, do a credit card.
Okay, okay.
So yeah, that would be. But
Yeah,
yeah,
I told him that, you know, a revolving account means you're constantly taking care of it versus something that has like a, you know, a deadline, a natural time of death. So a revolving should have more impact. So it's nice to know that.
yeah. So the beauty of the credit builder accounts that we use is it's a savings account that reports like a loan. So it's basically like a CD. You put money into it monthly, and then you pick a term anywhere from 6 months to 5 years, whatever they want. At the end of the term, they get the money back. They can choose to withdraw it early or close the account early. Then there's a small penalty, just like with a CD. It's a lot smaller than a CD. It's like $12.
Yeah.
But then it's tied to the credit card, right? So they give them access to a credit card after 3 months. So then they get both trade lines on their report, but only one product that they actually had to get to achieve both.
Cool.
So yeah, I can send you the link for it.
Thank you.
So yeah. Any other questions? Okay, well, we just hit an hour here in 2 minutes, so I think we made decent time, better than sometimes when I jabber too much. But if anything comes up, don't hesitate to reach out. We want to be a resource. We have a lot of you can join you're probably in our email list if you signed up. So we send a lot of content out that you can use with borrowers. And if you need any other content, just let me know. We're happy to make things for you. So thank you.
Awesome. Thanks.
Bye.